Okay, so just want to kind of get going here a little bit with Chapter 8, just some brief introductions here into the content, just to make sure we don't slip too far behind. Keep us kind of moving towards end of the semester, only a few weeks away. So here in Chapter 8, we're talking about proprietorships, partnerships, and corporations. Hopefully we've all heard these words, maybe just in common day language again, but here in Chapter 8, we really want to find out more about what each of these actually are. What are we actually talking about? Again, back to our course learning outcomes. What are we hoping to get out of Chapter 8? What are the areas that we need to understand better? Really, we're going to look at transactions still here as we talk about equity transactions, see how those impact our financial statements. We have a few calculations here related to our stockholders' equity that we're going to be looking at. Of course, the balance of these calculations are going to come in Chapter 9 here. So some of the key words, key new vocab items that you'll run into in the Learn Smart exercise. Partnerships, proprietorships, corporations. So when we think of big companies, publicly traded companies, that's where we're going to find our corporations. Partnerships, we might think of like a law firm or a CPA office, or even just a small business, maybe like a real estate company with some siblings, something along those lines where we have more than two people doing business as partners, but legally, partnerships are different than proprietorships, which are different than corporations. They all have their own entity formation and legal parameters that kind of govern each of those types of businesses. Proprietorships, we'll talk about those as we go, but basically that's just there's no difference between the person and the business. So we might think of like a handyman, a plumber, but there's not actually a formal entity that actually separates the person from the business. So even though they might be a handyman, they may still have a corporation that separates them personally from the business. So when we're talking about proprietorships, we're talking about actually no legal separation between the company and the business. But as we continue on with our conversation, as we work through the content here in Chapter 8, some of these things will come to light a little bit more clearly. So again, we're kind of back to this entity concept, our silos, right? Where we have our business here, our company here, we have an owner here, we have another owner here, we have our employees over here. So we're talking about how are these legally and how are they separated out? How are they actually distinct? Where the entity itself is very different from the owner or this employee. And that's what we'll start to see as we dive deeper into Chapter 8 here. So again, we have our sole proprietorship. That's kind of like the basic entity where there's no separation between the company and the owner. Then moving up the scale, if you will, we have our partnerships where we have two or more individuals that go into partnership together. And then we have our corporations, which issue shares of stock, and that stock is how we arrive at our ownership. That's how our ownership is made up, through those shares of stock. So some really key advantages to being a corporation. Again, we have that entity protection where we are a separate silo from the company, and that company can stand alone. Continuous life. Corporations don't live and die. Proprietorships, they die when the proprietor dies. Partnerships die when one of the partners is withdrawn from the partnership or a new partner is added. So it's actually there's there's continuous life that's available for a corporation. It's easier for corporations to raise capital. Ownership transfers are really relatively easy. Some tax disadvantages or some other disadvantages is that there is double taxation. And then because these companies are usually the largest companies, there's a lot more regulation on these companies. So let's take a look at some balance sheets here. When we talk about a sole proprietorship, we're talking about capital. That's their equity account. That's what they have in capital. That's what they've invested. That's for the corporations, that's where we've been spending most of our time. And we've had common stock and retained earnings. Here in our sole proprietorship, we have our capital account just for the one owner, only sole one, just one owner. So here he is, Worthington. Now here we have our Slater and Johnson partnership. So we have a capital account for Slater and a capital account for Johnson. What have they contributed? What have they taken out? What's been their share of income or losses? So that's kind of the dynamic behind, again, moving from sole proprietorships up to partnerships. And then we'd see common stock and retained earnings in our corporations. Okay, so let's take a look then at some key issues that revolve around a company actually issuing shares. We have this idea of par value. So when a company issues shares, they need to assign those shares a value. And this is just a nominal amount. It really has no impact on what that share is actually worth out in the marketplace. But the company is required to give it a par value. And we'll see how that comes into effect when we look at some transactions here, most likely later this week in class. Okay, so let's take a look then at just different categories, different types of shares that we can have. So when a corporation is formed, their paperwork, their bylaws dictate how many shares are actually authorized. So they might be authorized to have 10,000 shares or 1,000,000 shares, but that doesn't mean that they're going to issue all those shares. What they actually issue is going to be the most it can be is the shares that they're authorized, but most typically they actually don't actually issue all that they're authorized, and they actually have some unissued shares that they kind of leave aside here that are authorized but not issued. Then among our issued shares, we have our shares that have actually been sold to the public. Those are outstanding shares. But then within our issued shares, we can actually, as a corporation, we can buy back shares of our stock. We'll get into that just a little bit. Upper level finance and accounting classes get into it much deeper. But those shares that we actually buy back from our issued shares are called treasury shares or treasury stock. Okay, let's look a little bit here at our common shareholder rights. These shareholders have the rights to buy and sell their shares. They have rights to distribution of profits if we should happen to pay a dividend, or if the company goes bankrupt at the liquidation. These shareholders may have some liquidation rights. Most typically, though, in a bankruptcy situation, that liquidation is not going to have much in the way of assets remaining by the time we get to shareholders. But another good right that these common shareholders do have is the right to vote on significant corporate matters. So they would be balloted by the board of directors. so that their voice can be heard. They have a vote in those corporate matters. They also would be balloted for the election of the board of directors. So again, that board of directors is the ultimate leadership of a corporation. That's who the CEO and the CFO and the COO, all our chief executive, all our different officers of the corporation, they all report to our board of directors. So that's up the food chain, if you will, from those executives, and that's who they ultimately report to. But we as shareholders have rights to elect that board of directors. So there's some, kind of parliamentary, if you will, procedures there that give us some really good voice as shareholders in how that company is actually going to be run. Let's pause it there for our discussion on Chapter 8. I know it's kind of quite a bit. You might want to flip through this a few times just to kind of catch up to speed here if any of this didn't quite sink in. But we will also we'll pick up here in class later this week and continue on talking about shares and ownership and partnerships in corporations. So have a great week, guys. See you back in class. Take care. Thanks so much.